Welcome to our clients and those tuning in who might be new to Steadyhand. And thank you for joining our virtual cafe on managing taxes. Steadyhand's purpose is to help Canadians grow their wealth with a simpler, more human experience. And in keeping with that mission, and following upon last year's retirement series, which if you haven't seen the videos are available on our YouTube channel, we're thrilled to have Cynthia, Kett, and Tim Cestnick join us today to discuss all things about taxes. Now, having close to 600 people registered for this webinar demonstrates that we have hit a hot topic and we've got great panelists. Before introducing Cynthia and Tim, if you are new to Steadyhand and would like to know more about us, please visit our website and watch Straight Talk with Steadyhand for a great introductory video on why thousands of Canadians have chosen to work with us. Now to the topic at hand. Cynthia is a leading advice-only financial planner providing integrated, objective, and customized advice to wealthy Canadian families with complex financial situations. Cynthia has been a leader in the financial planning community for over 30 years. Tim is a familiar name to Globe and Mail readers, having penned over 1,000 weekly tax columns for 26 years. That's a tough gig. His insights are also found in 18 best-selling books, including Taxes for Dummies and 101 Tax Secrets for Canadians. When he's not writing about taxes, Tim is advising affluent clients at Our Family Office, a leading wealth advisory firm that he co-founded and leads as CEO. Tim, Cynthia, thank you both for sharing your expert perspectives and for kicking off the first Steadyhand Cafe of 2023. Now, our time together will begin with Cynthia and Tim sharing their top 2 takeaways or rules of thumbs that Canadians really should pay attention to. Then we're going to go deeper onto tax tips for people who are accumulating their wealth, and then we'll turn to those who are decumulating. We'll then look at what could or should be considered good debt versus bad debt in the sense of taxes, and how corporations and trusts might play a role in managing taxes, whether insurance could be a viable tax strategy. And then finally, we'll consider how to optimize our charitable giving ambitions through the tax code. Now that's a lot to cover, so enough from me, let's get going. And to kick things off, Cynthia, I'll turn it over to you to give us the top 2 things that Canadians should really be thinking at as they plan for and manage their tax exposures.
So a fundamental principle of tax planning is minimize taxable income. And 2 good ways to do that are to generate capital gains and to claim all the deductions to which you're entitled. So why capital gains? Well, if you sell your principal residence at a gain, you can claim the principal residence exemption. If you sell qualifying small business corporation shares or farming or fishing property at a gain, claim the lifetime capital gains exemption. But for most of us, the one that we're looking at is selling capital assets at a gain, because only 50% of the gains are taxable. The other 50% are tax-free. And then as far as deductions go, deductions have the potential to drop you into a lower tax bracket. So in addition to ones like childcare expenses or amounts for elected split pension amount, or investment carrying charges, the one that sometimes people forget about are losses from other years. They lose track of them. So you can carry losses forward from prior years or back from subsequent years. So don't forget about those losses. They can be quite valuable. Tim?
Thanks. Good to be with you both and with everybody on the call. As far as sort of my top 2 tax tips, I would say, first of all, get the basics right. Now, what I mean by that is that there's some obvious deductions and credits that people just miss all the time. And we won't have time to go through all of the details of all of them today. But, Cynthia's mentioned a few: childcare expenses, moving expenses, carrying charges, moving deductions for pension income, split income, RSP deductions, things like that. And credits include age credits, caregiver, home buyer's amount credits, home accessibility credits, disability credits, medical expenses, donations, things like that. And people miss a lot of these, can miss some of these things if they're not careful. So get the basics right. There's that. The basics also include just using RSPs. It's amazing the number of people that have accumulated RSP contribution room and are paying more tax than they should be, both on their portfolios if they have any, or just on their employment earnings or whatever it is. So RSPs provide that tax deduction and also tax sheltered environment to grow some of your assets. The basics also include splitting income with family members. So that could be kids or your spouse. Also just watching the type of income that you earn. You know, Cynthia talked a bit about capital gains, which are taxed at more favorable rates. Even dividends can be taxed at more favorable rates. So I'm not suggesting you should just throw all your investments that generate interest income out the window. You have to have a proper asset allocation and a proper risk profile to your portfolio, but be aware of the kind of income that it earns. And then another obvious thing that people forget about, you know, this is part of getting the basics right, is just claiming a deduction for things you're paying for anyway, things like a home or car. Now, how do you do that? Well, by having even part-time self-employment at home, earning a little bit of income, doing something on the side is not a bad idea, because you open the door to deducting things that you're paying for anyway. And that's the first thing. Get the basics right. The second thing I would say, make one change each year. And what I mean by that is find one idea you haven't implemented before and just put it into practice. Every year, the things that will save you tax. Do one thing a year, and over time, you'll be amazed how that accumulates and how it has a cumulative effect. So if you're splitting income with your spouse, say starting this year, that's going to benefit you this year, but also years going forward. So adding one idea a year to your list of ideas you're implementing will make a huge difference over time. So that's what I would suggest as my second tip, David.
David, you're on mute.
Thank you, Cynthia. I was thinking of what my tip might be, but I'm going to actually pose it as a question, kind of riffing off of your comment about RSPs, Tim, and doing one thing differently. Is it true that most Canadians are investing in their RSPs in this RSP season that we're deep into right now, when in fact, if they had the resources, they should be putting their RSP contribution to work at the beginning of the year rather than catching up in the next calendar year? Can you talk a little bit about that?
Yeah, for sure. I would hope that people who are contributing to their RSPs this month are doing that for 2023 and not making their 2022 contributions. I mean, if you have the means to do it, you want to contribute ahead of time. And so, it just gets your money working for you in that tax sheltered environment that much sooner. The tax deduction, of course, you can claim in either year. If you make the contribution before the deadline for this year, you can deduct it in 2022 or 2023, depending on your contribution limits. So smart idea to get that money working for you faster in the RSP.
Sorry.
I'm sorry, I just want to offer a caution there, though, is that there are significant penalties for over contributing. So if most people do wait until after they filed their tax returns for the prior year, just to make sure that they've got the RSP room right, because the penalties are really onerous.
Okay, fair enough. Well, thank you. We're going to run 2 quick polls now, which should be kind of fun and hopefully informative, insightful. So Lisa, if you could launch the first of our 2 polls, that'd be fantastic. Thank you. So the first poll is, do you do your taxes yourself, or do you engage an accountant or tax professional? And we're starting to see some results pouring in here. Seems to be going kind of splitting 50-50 right now. No definitive trend line, with about 30% of people having responded. I don't know whether Canadians are more inclined to do it yourself than other jurisdictions, but this is actually surprising me a little bit. So we're just coming up to 80% of the audience having voted, and we've got, call it 60-40. 60% are doing it themselves, and 40% are hiring a professional. I turn over to you two. Does that surprise you or conform with your expectations?
I'm not surprised by that. I think, depending on the complexity of your tax return, doing it yourself with the tax software that's available today is maybe just fine. I think it depends on how knowledgeable you are on the available credits and whatnot. But again, with the software that's available, you can do a pretty decent job. It's where you get into complexities like self-employment or dispositions of real estate or other complex kinds of tax planning that has to be reflected on your return, that it probably makes sense to get a professional involved.
Yeah, the more complex the situation, the more risk there is that you're not going to get it quite right.
And do you guys have a recommended do-it-yourself planning technology that you would suggest, or you'd rather not go there?
No, there's a variety of tax software applications that are available out there. I mean, the one that's most obvious is probably TurboTax by Intuit. It's probably the most best known one, but there are other ones out there. So, just make sure that it's a well-known name. It's a well-established firm that where the calculations are being done right, because CRA will redo the math if you don't do it right, even if you use software. And although CRA has to approve the software, so normally, if you're using the right kind of software, it's been approved by CRA. Make sure it's been approved by them.
Okay, thank you. Lisa, do you want to run with the second poll? So this one asks, are you confident that you have minimized your taxes? Are you confident that you, in the administration of your tax environment, you've minimized your taxes? And here we've offered a not sure, which I think is an entirely appropriate answer. And we're getting that's interesting. The audience is pretty confident. Got close to 60% answering yes, with roughly 75% of the answers. And that's trending back down towards 50-50 now, but interesting. This does surprise me a little bit that people are as confident as they are. So we have roughly 55% people thinking that they are confident they've minimized their taxes, and another 28, 30% not sure, with a fifth of the audience saying absolutely no way. Any feedback, any aha or surprise from this one?
I know. Well, my thought is I'm surprised as many people are as confident as they are about the fact that they're minimizing taxes. Maybe that, I don't know if that's misplaced confidence or if that's good. My experience has been that a lot of people aren't doing as much as they should be, but it doesn't, maybe by the end of this presentation, people will have some new ideas.
Well, why don't we launch into the first of our deeper dives, which is the accumulators. And we have about 50% of the registrants who indicated their age on the registration are in that accumulation stage. So, sort of running up to arguably 70 years old. And the other half are in that sort of 65 plus age. So I think there's going to be a lot of interest in both learning your ideas around how to manage taxes when I'm accumulating my wealth, and then how to manage taxes when I'm decumulating my wealth. And so we've asked Tim to kick off the accumulation side of things. And Cynthia, you're most welcome to weigh in with any additional thoughts you might have. And then we'll shift over to decumulators after that. Tim, over to you.
Sure. Okay. No, thanks, David. I'm going to talk sort of broad terms about registered plans for a second. Then I'll talk a bit about home ownership and real estate. I'll talk a bit about interest deductibility and then income splitting. But I think as far as accumulators are concerned, and we normally think about younger individuals, although you could be accumulating up until the day you retire, I suppose, and until you're not, until you're not drawing down on your nest egg. But I think one of the things people should be thinking about is the fact that both TFSAs and RSPs are valuable. If you can, you want to try to maximize your contributions to both of those. It may not always be easy because you've got competing interests or competing priorities for your money. So if you have to choose one or the other, generally speaking, you probably choose TFAs when your income is lower, typically at younger ages, and then maybe move to RSPs when your taxable income starts to increase. If you want to do the real math on it, you want to look at the difference between the tax rate you're paying today and the tax rate you expect to pay in retirement when you start drawing money out of your RSP, let's say. And when if you're expecting a much higher tax rate in the future than you are today, you know, that should give you some indication that maybe, well, and in fact, maybe it works the other way around too. When you're younger, typically your tax rate's much lower today. And so we would normally suggest putting money into TFSAs because you're not going to get as much of a tax relief for your RSP deductions as you will, say, in 5 years or 10 years from now, when you get much larger deductions for your RSP contributions. By the way, I'm not suggesting to skip your RSP. If you can make contributions to it, please do that. But if you had to choose between the two of them, if your income is relatively low and you're younger, you probably choose a TFSA. Also, I think when it comes to home ownership, there's been studies that have shown that home ownership, and maybe this is the reason why so many Canadians strive for home ownership, does lead to greater financial stability. And, you know, home ownership does provide the opportunity to create wealth, but also save tax. Because as you know, if you were to sell your principal residence, it can be sold tax-free. And wealth creation, well, we know what happens to real estate, what has happened to real estate over the last number of years. And real estate still, over the long term, I think is still going to be a very good investment. In the immediate term or the very, very short term, anything can happen with interest rates going up and prices being as escalated as they are. But over the long term, it should still be a smart idea to buy real estate. So start small. If you're looking for your first home, your first home doesn't have to be your last home. I think that's important to realize. And also, you may want to consider finding a renter to help defray the costs of owning a home. Have maybe someone in the basement to rent out a basement apartment if you can do that. That also creates deductibility for mortgage interest and property taxes and other home-related costs. Also, make smart mortgage payments. You know, pay bi-weekly or double up your payments. You know, most mortgages will allow you to pay double what you normally have to pay for your payment if you have the ability to. And also pay down lump sums on your mortgage annually if you can, or as you come up with, you know, more money from time to time, put it against your mortgage. But have a long-term focus when you own a home. It's not something, you know, if you told me you were going to sell your house in a year or two from now, I'd say don't bother gambling and buying a house. You might end up losing money on that over that short period of time. I think also taking advantage of the first-time home buyers savings account, the FHSA, which is actually not available just yet, but they will be available anytime now, very soon, as financial institutions get their technology together. FHSAs allow you to save for a down payment for a home. You get a tax deduction when you contribute, and you can pull the money out tax-free after a period of time when it's grown over the course of time. It comes out tax-free. So it's kind of like a cross between an RSP and a TFSA. You can contribute up to $8,000 annually, up to $40,000 in a lifetime to a first-time homebuyer savings account. So to me, this is a no-brainer. If you have not owned a home in the last 5 years, then you are considered a first-time homebuyer, and this should be a no-brainer. You should be setting one of these up as soon as you can.
Hey, Tim, can I interrupt you on that? How does a parent who's trying to help their child buy a house use this new account type?
Well, that's a good question. You know, unfortunately, if the parents have owned a home, or if a parent or their spouse has owned a home in the last 5 years, and then they can't contribute to one of these for themselves, but they could give money to an adult child to contribute, which may be another way to help a child.
And the tax credit then goes to the child?
Yeah, the child gets the tax deduction because they're the ones making the contribution. Okay. So you're really gifting money to the child, and then they use that money to then contribute to a plan. I think also another thing to think about is making interest tax deductible. So interest rates are going up. If you can reduce the after-tax cost of interest, it's going to help. How do you do that? Well, if you happen to have any cash or investments that you can use to maybe pay down some debt, some bad debt or non-deductible debt, then you could pay that debt down and then re-borrow to replace the cash or the investments. Then what you're doing is you're borrowing for income producing purposes, and now you can fully deduct the interest on your debt. That makes good sense, and that's what we call a debt swap. Another idea, which I mentioned earlier, is to maybe rent out part of your home or start a home-based business. This provides ability to deduct part of your mortgage interest if you have a mortgage. So make interest deductible if you can. Also, last thing I'll just talk about is splitting income with a spouse or children. But in the past, we've seen people set up loans to their spouses, spousal loans, we call it, because you can't just give money to your spouse and have your spouse earn investment income and then have your spouse pay the tax on that investment income. That income will be attributed back to you, the one who's provided the money. So what you can do is you can lend money to your spouse. The challenge with that today is that the prescribed rate, which you have to charge, is now up to 4%. And that's pretty high. It's still not necessarily a bad idea, but there may be other ways to split income with spouses as well. For example, you could have the lower income spouse invest every dollar that they earn if they're earning income, and have the higher income spouse pay for the household bills. That's one way to get income into the hands of the lower income spouse. Or just use or create second generation income. So for example, I could lend money to my spouse. I don't have to charge interest on it even. And if I lend my spouse a certain amount of money, well, the income that's being earned on that in the first year is going to be taxable in my hands. But the income on the income can be set aside in a separate account, and that takes on a life of its own. And that will not be subject to attribution or a tax in my hands. It can be taxed in my spouse's hands. So this is another way to start splitting income if you have a spouse and you want to start to save tax as a family. So those are some ideas for accumulators. There's lots more we could talk about, and we might today, but there's a start.
I think we'll probably get into that. Is it called the Smith maneuver, the debt swap? Or is that
the Smith maneuver? That's really what that involves is really paying down the debt that's not deductible, and as you do that, re-borrow and put the money into an investment account or to generate income. So the amount of your debt stays the same, but your debt becomes more deductible over time. And you can set this up as a routine procedure. So every month when you pay down your mortgage by this much, you can then borrow that much and then deposit that into an investment account. And over time, you're creating debt tax deductions and growing a portfolio.
Okay. Well, we'll probably get into that in more detail in the good debt, bad debt discussion. Cynthia, do you have anything you'd like to add to the accumulator stage of life?
Well, actually, I wouldn't mind touching on that Smith maneuver thing right now, just because it's sort of, fresh in everybody's mind.
Sure.
The one thing, from a purely tax perspective, that maybe makes sense to use that sort of maneuver. However, I really want to emphasize that it means you're leveraging investments, and that doesn't always work out well, right? So everything's terrific as long as the investments go up. But if the investments go down and you still owe the same amount of debt, then you know what? Maybe this isn't such a good idea. So I just want to touch on that right now because we brought that topic up. So.
And I know we'll be talking about borrowing to invest in a few minutes, but I agree with you on that, Cynthia. And so my general rule is if people are going to borrow money to invest, they need to have a very long-term time horizon, first of all, and just be careful about the kind of investments they choose. They need to be more sort of blue chips, stables, secure kinds of investments, not penny stocks, not things that are going up, not gold, not cryptocurrency. Like, you need to be very conservative and you need to have a long-term time horizon.
The other thing I'd just like to touch on, doubling back to what Tim said about the RSP and TFSA contributions, absolutely agree with everything that he said. I'd just like to add one other thing is that keep in mind the following. If you plan to withdraw the contributions in the foreseeable future, then put it into the TFSA, because when you withdraw that money from the TFSA, that withdrawal will not be taxable, right? And the other thing is that when you withdraw those previously contributed amounts, you restore your TFSA contribution room, and you can put the money back in as of the following calendar year. So those are just a couple other things I wanted to add on to what Tim said, but absolutely everything he said I agree with.
Thank you. Well, why don't we switch gears to the decumulation stage of life? And that is when people are trying to unravel the mystery of an RSP to a RIF, a LIRA to a LIF, minimum maximum withdrawals, CPP, when do I take that? OAS, clawbacks, oh my God, how does this all fit together? And we often find our clients, when they're sort of shifting into that dynamic, those are very rich conversations. And sometimes, given the complexity, we'll make a referral to somebody like Cynthia, who is an advice-only planner who just does financial decumulation retirement plans. So Cynthia, perfect topic for you to synthesize and make it really easy and simple for us.
Okay. So let's talk about OAS and CPP first, because that's a question that usually comes up early on. I'll just review some of the parameters for people who might not be familiar with that. So OAS you can take as early as age 65 or as late as age 70. And so if you decide that you're going to defer taking OAS until after age 65, then your benefits will increase by 0.6% for each month you defer. So the maximum cumulative benefit of deferring to age 70 would be 36%. A similar thing applies with respect to CPP. So you can take CPP as early as age 60 or as late as at age 70. So if you take your CPP before age 65, then for every month earlier than age 65, your benefit will be decreased by 0.6% to a maximum of 36%. But if you decide to wait past age 65, then your benefits will increase by 0.7% for each month that you defer that benefit to a maximum increase of 42%. So that all sounds really good, but how do you decide, right? So the first question is, when do you need the cash flow? So some people are working longer, and in that we're seeing a lot of people doing staged retirements, and that's partly because they don't know what to do with themselves if they were to stop working. But others, they like to be engaged, and for lots of different reasons, people are working longer, and so they're still earning income. Maybe they don't need the cash flow, so that could be a reason why you defer it. Others who have retired early might say, my tax rate is really low. My marginal tax rate's low. Maybe I should take this income now, especially OAS. If once they RIF their RSPs, they're going to, pole vault into the top marginal tax bracket. Well, maybe you take OAS now so that you're keeping some of it instead of having it all clawed back. But a lot of it depends on when you're going to get the maximum utility out of it. Am I going to enjoy this income when I'm young enough to go out and do all those crazy things I want to do and travel the world or whatever? If I can use that cash flow now more than later, then that's a prime consideration. The second consideration would be, how does it affect your tax planning during retirement? So you really need to know what your tax bracket's going to be during retirement. So again, where does that where's the sweet spot? Where's the sweet spot for taking that income into taxable income? And also, do you expect to live past age 86 or 87? It's somewhere in there. It's kind of where the break-even age is. So when they did all these calculations and figuring out how to decide, to increase or decrease the benefits depending on when you take them, it was sort of in around age 86, 87, depending on your year of birth. So, the thing is, we don't know. None of us knows how long we're going to live. So, but, if longevity runs in your family and they all live past 100, well, chances are you will too. Secondly, what order should you draw down your investment assets? So, of course, this is another big topic. To minimize taxable income, remember, that's one of the key principles, you would, generally speaking, draw down on non-registered assets and TFSAs, between date of retirement to age, say, 71. and then your RSPs or RIFs, as you are required to RIF and draw down minimum income. But again, it depends on your own individual circumstances. So if for some reason during that intervening period from when you retire to age 71, you've got that low taxable income, then hey, take some of that tax sheltered income now and make good use of those low tax brackets. So take your RIF, either RSPs or RIF income out, and have it taxed at, say, 30% instead of wait till later and have it taxed at 53% or whatever. And then finally, and this is the overarching thing that we would always recommend, do retirement tax planning at least 5 years in advance of your possible retirement date, right? So once you're ready to close the door on work, it's hard to turn around and go back. So you want to know 5 years in advance, are you in good shape? And then consider joint retirement income. So if you have a spouse or common law partner with whom you're going to plan, you want to use pension income splitting to maximum benefit. So when you're doing your retirement planning, you can model that, see how that works out for you. For the years between age 65 and 71, if you don't have any other eligible pension income, consider riffing some of your RSPs to generate at least $2,000 of eligible pension income so that you can essentially get that money out of your plan tax-free by claiming the pension income credit. And then finally, I would say that if you have control over the timing of your retirement income, which some people do, so if you can choose when to trigger capital gains or when you can draw taxable dividends out of a holding company, or things like that. Like if you have some degree of control, then you might be strategic and try and have a low income tax year, so you get to keep more of your OAS, versus a high income tax year, and you kind of dump it all into 1 year. So you lose the OAS for that year, but that way at least you can get some of it.
I know it's always circumstantial, it always depends, but I had to get this RSP meltdown thing off my chest. You were kind of referred to it a little bit, Cynthia. That's where you would draw down deliberately on your RSP before it riffs in order to take that money out of your RSP when you have a lower kind of taxable income situation. I'm just wondering, between the two of you, is there what is the number one, when it comes to decumulation, what is the number one mistake that we're making as Canadians, or the number, if nobody take anything away from what you just said, Cynthia, what is the number one thing they need to take away?
Do your retirement planning 5 years in advance. I can't, because otherwise the other approaches are you keep spending as you always have and hope everything works out.
Right.
Or you say, okay, I'm only going to spend the income and not the capital. Well, that's all well and good as long as you wanted to leave a big estate. Right. But if you've worked hard all your life, you accumulated so that you could enjoy retirement, not necessarily leave it all to your children. So that doesn't work. So planning is important. Yeah.
And Tim, what do you, from your practice, what do you think is the most important thing or the biggest mistake we're making?
Well, I think Cynthia has addressed the issue of, the order of drawing down on your investments. It's really about minimizing tax because you can only spend what you keep after taxes. So, people just don't often pay attention to the order in which they draw down on their investments. One other thing I'll just add, and this is all good information, Cynthia, it's great. I think related to RIFs, obviously, if you're setting up a RIF for the first time and you're converting your RSP to a RIF, you want to use the age of the younger spouse if you can, just to defer the tax a little bit longer and pull money out of your RIF a little slower if you can. There's another idea that I've written about in the Globe and Mail, which, as I do the math on it, can actually work quite well in a lot of situations. And that is a situation where, if you think about it, when you pass away, let's say you pass away at 85 or 90 years of age, and in that year, if you have a very substantial RSP or sorry, RIF by that time, it'll be a RIF. If you have a very substantial RIF, that's going to be subject to full taxation in the year of your death, unless you have a surviving spouse. But if you don't have a surviving spouse, it's a lot of tax to pay. And the tax rate that you could be paying, it could well push you well into the highest tax bracket for many people. So some people will face the prospects of paying tax at 53% almost, or 50% on their RIF assets when they pass away. So their kids will inherit a lot less. One thing you can consider doing today, and it's a mathematical calculation that has to be done for everybody because everyone's different. You could actually withdraw funds from your RIF a bit early, pay tax at a lower rate today if your rate is significantly lower than it will be when you die, and take that money and invest it outside of the RIF, maybe in a TFSA if you have TFSA contribution room. And then when you pass away, money comes out of your TFSA tax-free. And it reduces the amount that will be in the RIF on the year of death. Again, don't just assume this is right for everybody. You have to have the math done on it, but it's something worth considering.
Fabulous. Thank you. Well, I know, Cynthia, you're chomping at the bit to talk about debt. So let's shift now, and you're going to lead us off on the discussion around good debt, bad debt, and no doubt Tim will want to weigh in as well.
Yeah. Tim touched on this topic a little bit earlier in his top tips at the beginning there. But good debt is where the interest is deductible, and bad debt is the kind where the interest is non-deductible. So good debt would be things like loans for business purposes or loans for investment purposes. With good debt, the pre-tax interest rate is equal to the stated interest rate. So if we think about it in a different way, let's say you have $10 of interest expense to pay, right? There's your $10 bill, and you need to pay that interest expense. So if it's deductible debt and we borrowed to invest in a rental property, we only need to generate $10 of rental income to pay that $10 interest expense, right? Easy peasy. But in the case of bad debt, where maybe for mortgages or personal use real estate like cottages, car loans where you don't use a car for business purposes, lines of credit to fund lifestyle expenses like your last big vacation, the effective pre-tax interest rate could be 1.5 to 2 times the stated interest rate, depending on what your marginal tax bracket is. So if we put it in terms of that $10 of interest expense again, if I was in a 50% tax bracket, I'd have to earn $20 of income, pay $10 in income tax to have $10 left over to pay that $10 interest expense, right? Or if I was in, a 33 1/3% tax bracket, I'd have to earn $15 and pay $5 in income tax to have $10 left over to pay the $10 of interest. And so that's why it's deceiving when you see a mortgage rate. When we used to think, mortgage rates were 1.5%. They were really low. They really were low. But they're really costing you more like 3%, right? But right now, with them having come up so much higher, now we're looking at mortgage rates of, say, 5.5%, 6%. Now we're looking at pre-tax interest rates of 11%. Now we're talking real money, right? We can't generate a guaranteed rate of return of 11%. So in this case, your best use of excess money is to pay down your mortgage, right? and make good use of all those, one-time 20% payment to principal, double up payments, accelerate payments. That's a good idea. That's a really good idea. That's all I have on that. We touched on some of the others.
So I couldn't agree more, Cynthia, on a number of those things you've said. I think, I think obviously if interested is deductible for tax purposes, it makes it a lot more palatable. And I think paying down debt with extra cash you have lying around is a terrific use of that money, because I think, as you mentioned, it's like getting a guaranteed rate of return. You pay down your mortgage or pay down your debt. What have you earned on that money? Well, you've earned the rate of interest on the debt that you're no longer paying. It's really a good idea. I would add a couple of caveats to that. I would say in my mind, there are some cases where even if you can't deduct your interest for tax purposes, it might still not be a bad kind of debt. It could be still good debt. I think that might be where, you're buying an asset that's appreciating in value over the long term. You just have to be careful. Like a home, I think a home mortgage or a cottage can be a good asset to buy, even if you're not deducting the interest, provided that you have a long-term view and provided that your borrowing terms are reasonable. Mortgage rates are higher now than they have been, so we have to factor that in. And speaking of borrowing terms, I've met an individual recently who borrowed from a private lender to buy a home. And if you're in the situation where you can't borrow from a financial institution, but you're borrowing from a private lender, either for a home or even for a rental property or something, I think you have to ask yourself the question, should I be borrowing this money? Because the interest rate is going to be so high, the terms are probably so restrictive that in that case, it's probably just not a good idea. And so I think the terms of the debt really matter a lot too on defining whether it's good or bad debt.
Let's take good debt and shift into this whole concept of trusts and corporations, because I know part of what supports a trust is actually lending money. And Tim, why don't you kick us off with your perspectives on how trusts and possibly corporations can play into people's tax planning?
Sure. First of all, let's talk about corporations. I think corporations can make a lot of sense if you carry on an active business and if you're earning income from the business, and if you don't need all of your earnings to live on. So if you needed every dime that you're earning, you're not going to be leaving anything in the corporation anyway, if you happen to have a corporation. So you're not really gaining any benefit from having the company there.
Tim,
but
by way of corporation, are you referring to a kind of like a passive income corporation, or as opposed to an operating corporation?
Well, every corporation is the same. And every corporation can have different kinds of income. You can have passive income, or you can have active business income in the same corporation, in fact. I'm really talking about situations where you're carrying on an active business and you're contemplating doing that through a corporation. So in that case, small business corporations pay tax at a reduced rate on active business income, a lower rate than you'd pay personally. So for example, in Ontario in 2023, you'd pay just 12.2% on the first $500,000 of active business income in a corporation. So if you can earn active business income in a company, and if you can leave some of it there, because maybe you don't need to live on all of it, that's where you start getting a benefit to this low rate of tax that the company is paying, because you're paying tax at just, call it 12.2%, and you're left then with over 88% of the money you earn, or the money you're leaving in the corporation, and that can be reinvested now inside the company. I won't get into the rules around that and maybe when that starts to become a problem, but generally speaking, you can reinvest more dollars if you earn active business income in a corporation. As far as older folks go, maybe people who don't have a business, sometimes we use corporations to reduce exposure to probate fees and U.S. estate taxes. So by transferring certain assets into a corporation, you don't have to put that corporation, the shares of that company, through probate. So depending on the size of your estate and how much you're putting in the corporation, you could save a lot of money in probate fees. That generally makes sense if you're sort of into the millions of dollars that you're, at least a few million anyway, that could make sense. And likewise with U.S. estate taxes, if your estate is bigger, and that's a potential problem, and it can be a problem, by the way, for Canadians who've never set foot in the U.S. If you own certain U.S. investments, for example, you could be subject to U.S. estate tax depending on the size of your estate. It has to be a pretty big estate for that to be a problem. But in that case, corporations can make sense as well. And also, if you're going to use a corporation for those ideas, reducing probate fees, reducing U.S. estate taxes, or maybe active business income, you can also preserve old age security benefits. They get clawed back, as you know, when you have a high personal income. If you have some income that would otherwise be taxed in your personal hands, but now it's being taxed in a corporation, then you might avoid some clawback of old age security benefits. I would never set up a corporation just for that reason, by the way. It's not enough of a reason to do it. But if some of the other reasons for setting up a company make sense, you might want to consider it. Now, just to talk about trusts for a second, trusts can be valuable if you want to place beneficial ownership of an asset into someone else's hands, but you still want to maintain control, for example. When does this make sense? Well, for example, if you want to split income with family members, you could lend money to the trust, for example. Lend money to a trust. You'd have to charge interest at the current prescribed rate, which is 4%. Now, to the extent you're earning more than 4% in the trust, then that difference is what effectively is a tax in the hands of the family members that you name as beneficiaries of the trust. So, this worked much better when prescribed rates were lower, but they may come down again and in the future. And it could still make sense depending on what kind of income you're earning inside the trust. So trusts can also make sense if you want to set aside assets for the benefit of, say, a disabled beneficiary, either during your lifetime or at the time of your death, where maybe someone can't manage their own money, but you want the money there for them, and you want to name someone else to manage the money. A trust can be a perfect tool for that. Also in the context of what we call an estate freeze, where maybe you want to pass the future growth of an asset to somebody else so that you're not taxed on that future growth when you die. So if you took an asset today that's grown in value and it's going to continue to grow, that could just give rise to a bigger tax bill when you die. What you can do is something called an estate freeze, where you cap the value of that asset today in your hands and pass the future growth to typically a family trust or a corporation owned by a family trust. And that minimizes taxes at the time of your death. That can be very, very helpful and it's pretty common planning for many Canadians who are business owners or have a little bit more in assets. That can make really good sense. Typically, you wouldn't do that until that estate freeze probably wouldn't happen until you're 50 plus and maybe even 65 plus in age. But those are some ideas where you might use trust as well.
And can you just explain what the prescribed rate is?
Sure. There's an interest rate that is set under our tax law called the prescribed rate, and it's used for a lot of different things. It can be used to calculate taxable benefits for employees. So let's say your employer gives you a loan and doesn't charge you any interest or charge you a very low rate of interest. Well, the government would look at that and say, okay, what's the prescribed rate? Oh, you paid less than the prescribed rate? Well, now you've got a taxable benefit. Likewise, if you are going to try to shift income from yourself to, say, a spouse, you can do that, but you may have to lend that money to your spouse and you'd have to charge the prescribed rate in order to avoid that income earned by your spouse being attributed back to you. So the prescribed rate is used for a bunch of different things. It's also used, by the way, to calculate how much tax or how much interest you might be owing on overdue taxes. So maybe you owe money to the government and you haven't paid it yet. Well, the prescribed rate, everything's based on the prescribed rate. So the amount of interest you're paying on those overdue taxes is based on the prescribed rate.
And it varies with the Bank of Canada rate.
It does. It varies with Treasury bills. And it changes potentially every quarter. And it's actually based on the average 90-day T-bill rate for the previous quarter.
Hence, it went from 1%, say, a year ago to now 4%.
4%.
Okay, cool.
Yeah.
Great. Cynthia, did you have anything you wanted to add to the whole trust corporation discussion? I know you do a lot of that in your practice.
Yeah, just a very quick hit, because I know we're running a little bit behind. So just that whenever you're evaluating these types of strategies for corporations, you need to consider the combined corporate and personal taxes payable to decide whether it makes sense. And also that trusts are effective tools for other than tax planning reasons, beneficiary protection, asset protection, estate privacy.
Thank you.
Yeah.
All right, now to the part of the discussion that is even more mind-bogglingly complex than anything else we've talked about, and that is insurance. And Tim, you're really going to have to work hard to simplify this for us. And
Yeah.
I'm only going to give you 3 minutes.
Yeah, we'll get through this quickly. I'm not going to spend a ton of time on it, but I will say this, that before you buy life insurance, you need to understand a couple things. First of all, what is the purpose? Why are you buying the insurance? There has to be a reason for it, a purpose. Once you know the why, that'll lead to answers about how much and the right type of insurance. There are a lot more reasons potentially to buy life insurance than people may realize. I did write an article back in August in the Globe and Mail that sort of talked about the top 10 uses of life insurance in sort of tax and estate planning. I'll run through them really quickly here, and then we'll call it a day. Number one, provide for dependents. So if you're the breadwinner in the family and you're gone and you're no longer earning income, how will that impact your family? You may need to have a pool of money there to provide some income to your family. So providing for dependents. Secondly, funding for specific purposes. Maybe when you die, you want to pay off some debts of a family member or your spouse, or pay for the education costs of a child or a grandchild, or cover maintenance costs for the family cottage that you're leaving to the children, or you want to support a pet. You know, these are specific reasons why you might buy insurance, to provide for specific things. Third idea, building retirement savings. Certain insurance policies allow you to build up an investment component, and it's sort of similar to an RSP or a TFSA, where the money can grow without any tax on an annual basis in your hands. So it's kind of a tax sheltered environment. Normally a fixed income portion of a portfolio could be maybe sheltered inside a inside of an insurance policy. Fourthly, equalizing inheritances. So maybe you're leaving one child with, say, the family business, and you want to leave the other child with something of equal value, but you haven't got something that valuable. You know, maybe you can equalize things by using life insurance to leave to the other individual. Fifthly, paying off debts, which I kind of talked about. It's always good to pay off mortgages and things when you pass away, if you're leaving a surviving spouse or a family member behind. Number 6 would be covering taxes on death. If you owe taxes when you die, maybe you've got enough liquidity or liquid assets to pay the taxes, but maybe you don't. If you own private company shares or real estate, those things are not very liquid. You might need insurance to help cover the tax bill. Next, eliminating taxes, not just covering taxes, but actually eliminating taxes. And I won't get into how that's done, but there are ways to do that using charity.
Now you got my interest.
There's lots of ideas, but a few ideas on how you can eliminate tax, including cascading insurance, where you buy insurance in the life of a child, build up investments inside that policy, and then transfer the policy later in life to the child when they're an adult. That's a tax-free transfer to them. So you're effectively moving assets from your name to their name tax-free. Next, donating to charity. Maybe you want to leave money to charity when you're gone. That can be done through life insurance. Funding a buy-sell agreement. So if you're a business owner and you die and you're leaving behind a surviving partner or business owner, they may need to buy your shares from your estate. And where's that cash going to come from? A buy-sell agreement can fund that, which is using life insurance. And lastly, providing key person protection. So if you own a business and there's somebody key or really critical to the business, and then they die, and that has an impact on the business, life insurance can actually help to soften the blow a little bit and provide the company with cash maybe when it needs it. Anyway, those are just some ideas to think about.
Thank you. And is life insurance tax-free like around the world, or is this unique to Canada?
No, generally speaking, in all industrialized countries in the world allow for insurance to be paid out tax-free. They all have slightly different rules around how much you can accumulate inside of a policy and what kinds of policies are available. But generally, you'll find that they all pay out tax-free.
Thank you. Cynthia, you're chomping to talk about philanthropy, charitable giving. I know it's very personal to you. You're very active. You're a huge proponent of the Hospital for Sick Kids, for example. Before we move into that, did you want to add anything on the insurance side, or would you want to just jump into philanthropy?
Just very quickly. So going back to Tim's initial comment, like, why are you buying the insurance? Are the insurance needs temporary or permanent? So, if they're temporary, then maybe you buy the cheapest form of term insurance, right? If it's permanent, then you have to be thinking long term and also be looking at the different types of permanent life insurance, whole life, universal life, term to 100. That's it.
Thank you. Well, there have been some really cool developments in Canada over the last 2 decades that sort of conjoin the securities or investment world with the philanthropy world. And I'm a huge proponent of that concept, but I'll turn it over to you, Cynthia, to talk about how to use the tax code and our assets to maximize our charitable ambitions.
Okay, so just as a primer for people who don't know, if you donate personally, you get tax credits for making donations. And if you make a donation through a corporation, it's treated as a deduction, right? And so if you were to say donate $1,000 to your favorite charity, and you had, you know, another 200 to at the low rate of donation, but depending on the jurisdiction that you're in and the tax bracket you're in, that $1,000 donation credit may or may not completely offset the tax you would have paid on the $1,000 of income. Okay, so it is really dependent, and for that reason, tax planning has to incorporate philanthropy, especially if you're considering a large donation. Corporate donations are tax deduction, as I mentioned. So keeping those differences in mind, one of the best things that you could do is to donate appreciated securities, appreciated public securities. And if you donate them personally, then, and there was an unrealized capital gain on that donated security, the capital gains would be taxed at 0% instead of 50%. So that's a huge win. But in addition to that, you receive the donation credits for the full value of the security that you donated. So huge win on 2 fronts. On the corporate side, it's actually even get another bonus. So on the corporate donations, in addition to the fact that the capital gain is taxed at 0%, and you get the full deduction for the full value of the donation, you get an addition to the capital dividend account, which is a notional tax account for private corporations, for CCPCs. And down the road, you could declare a taxable dividend, a capital dividend to yourself, and it come out tax-free. So so if a corporation donated $10,000, and let's say it had a cost of close to 0, now you've avoided paying tax on a capital gain for $10,000, and that $10,000 gets added to your capital dividend account. Later on down the road, you can take out that $10,000 tax-free. So that's a really nice one. Tim mentioned you can donate life insurance. So if you donate your insurance policy, would be one of the permanent kind of policies, whole life, universal life, then the receipt would be for the cash surrender value of the policy at that time. There are some exceptions, but generally speaking, it's a cash surrender value. If you donate the policy and then continue to pay the premiums, you would also get a donation credit for making those premium payments every year as well. And then thirdly, if you were to donate the life insurance proceeds upon your death, then the receipt would be for the fair market value of the death benefit. So how do you decide? How do you decide when you should give and what you should give? Again, it is all tax planning as well, because most people give because they want to, not for the tax benefits. But by the way, isn't it nice that we do get some tax benefits? So you want to consider, if you're donating personally, how and when the tax credits can best be used. Because if you ended up having, donation of death benefits when you pass away, well, maybe your estate and or, on your last final return, you can't make use of all those donation credits. So maybe it's better to be donating during your lifetime, right? And then shelter, having those tax credits against high income use. So really you want to consider financial planning. Can you afford to give this gift if it's a large gift? Tax planning, how can you best use these donation credits or donations, and as well as personal satisfaction. Maybe you want to see your money at work and you want to get the satisfaction of seeing whatever that charity does with your money.
Yeah, that's a great summary. Thank you. Tim, did you have anything that you would like to add to that?
Yeah, I know we're running short on time. I won't add much to that, but I will just say that I think when it comes to strategic philanthropy, you want to make it exactly that. You want to make it strategic. And so I would encourage people to come up with what's called a giving allocation, similar to an asset allocation that you might use for an investment portfolio. Decide which areas you want to give in, which areas are most important to you. Is it sports and recreation? Is it child welfare? Is it domestic poor? What are these areas that are important to you? And then once you've broken down that into percentages, maybe half your money goes to healthcare, half goes to whatever areas, then you can drill down into which charities in each of those areas sort of are aligned with your values and what's most important to you. I would it's almost like an investment approach to giving.
Yeah, in our own family situation, we've decided to allocate our philanthropic gift as a family to the Toronto Foundation. And then as a family, we meet regularly to discuss how we're going to actually allocate that. So the administration of our philanthropy is through the Toronto Foundation, and it's a great family activity. And so it's another great opportunity for a family to come together and talk about important community things. So we could go on forever, but we can't. So I want to say to both Cynthia and Tim, thank you for your preparation in leading up to today and for your fantastic insights and perspectives. I know I personally am going to go back and watch this video several times to really pay attention to what you were saying and make sure that we've dialed up all of our capabilities in the Toyne household. So what's next for everybody else? You will get an email from us tomorrow, Friday, letting you know that the recording of this is on our YouTube channel. I would encourage you to share that email in the YouTube recording of this to anybody you think might benefit from it. You're also going to get a quick survey from us, very quick survey as you exit this webinar. We encourage you to take a moment to tell us how we did, what other topics you want to hear about from us, because we're committed to doing 3 more cafes this year, and we've got some ideas, but we want to hear from you. And again, if you are new to Steadyhand, you want to learn more about us, go to Straight Talk with Steadyhand. It's on our website this afternoon, and it'll give you a great introduction to who we are. Thanks, everybody, for staying with us today. Thanks, Cynthia, Tim. Awesome event. Appreciate it. Bye for now.
Thank you.